China's manufacturing slump. July 2025 factory activity contracts unexpectedly. Imagine a scenario where the economic powerhouse of China, known for its robust manufacturing sector, unexpectedly shows signs of slowing down. That's exactly what a recent private survey has revealed, painting a concerning picture of the country's economic future. On July 31, 2025, the S&P Global Manufacturing Purchasing Managers Index for China dropped to 49.5, down from 50.4 in June. This is particularly alarming because it falls below the crucial 50-point mark, which indicates contraction rather than expansion compared to the previous month. Economists had forecast a more stable reading of 50.2, suggesting that the actual decline was even more significant than anticipated. But here's where it gets controversial. Could this unexpected contraction be a sign of broader economic challenges ahead, or is it just a temporary blip? Some experts argue that China's manufacturing sector has been under pressure due to global trade tensions and shifting consumer preferences. Others believe that the government's recent economic policies might be having unintended consequences. And this is the part most people miss. The impact of this contraction extends beyond just manufacturing. It could signal a broader slowdown in China's economy, which has far-reaching implications for global trade and investment. To put this into perspective, consider the ripple effects of China's economic performance on the global market. A slowdown in China can lead to reduced demand for raw materials and finished goods, affecting countries that rely heavily on exports to China. It could also influence global commodity prices and interest rates, impacting economies worldwide. So, what do you think? Is this a cause for concern or just a minor setback? Share your thoughts in the comments below. This could be the beginning of a significant shift in the global economic landscape, and it's worth discussing. China's manufacturing slowdown. What it means for the global economy. China's factories are hitting a cold spell, and it's more than a seasonal chill. Both exports and domestic demand are faltering, raising real questions about the engines that usually power the world's second-largest economy. But here's where it gets controversial. After months of strong export activity fueled by anticipation of steeper U.S. tariffs, China is now seeing that advantage quickly evaporate, and local consumers aren't picking up the slack either. In July, China's official Manufacturing Purchasing Managers Index, PMI, slipped further, dropping to 49.3 from June's 49.7, according to the National Bureau of Statistics. For those unfamiliar, a PMI below 50 signals contraction, not just slower growth. Forecasters had expected 49.7, but the reality was weaker. This is the lowest reading since April, marking 4 consecutive months of shrinking activity. And this is the part most people miss. It's not just manufacturing that's feeling the heat. Services and construction are also losing momentum. The non-manufacturing PMI fell to 50.1, teetering on the line between growth and contraction, and the services component dipped to a flat 50. Even with summer vacations in full swing, travel and leisure aren't delivering the hoped-for boost. Digging deeper, the data reveal that new export orders have now been contracting for 15 straight months, nudging down in July to 47.1 from 47.7. This trend confirms what market watchers have feared. The spike in exports seen earlier this year was more about exporters scrambling to beat looming tariffs than a sign of healthy, sustainable demand abroad. On the home front, total new orders slumped from last month's positive territory into contraction, clear evidence that Chinese consumers remain conservative spenders in the post-pandemic landscape. Several factors are adding fuel to this cooling trend. As pointed out by NBS statistician Zhao Qinghe, July's traditional production lull was exacerbated by extreme weather, including stifling heat and serious floods, slowing output and keeping employment lagging as factories cut costs. At the same time, prices for raw materials edged up, while steep price cuts among manufacturers also contributed to industrial deflation. That's why top Chinese policymakers are now promising a crackdown on so-called disorderly competition, essentially attempting to rein in destructive price wars. Another twist, the recent 90-day tariff truce between the U.S. and China, may have paused the most severe economic pain, but overcapacity, a persistently weak property sector, and limp household demand remain unresolved threats. Is China's old model of state-led, export-heavy growth finally running out of steam? Some analysts argue it's time for Beijing to put more effort into boosting domestic consumption, a pivot underscored by the new childcare subsidies rolled out this week. While 3,600 yuan, $501 per year for toddlers might not transform family budgets overnight, it's a signal of shifting priorities towards supporting households and stimulating internal demand. Interestingly, China's economy still managed to grow 5.2% in the second quarter, helped partly by delayed tariff hikes and government support, even sparking the IMF to upgrade its growth outlook for the year. Yet, beneath those headline numbers, stock markets in both Hong Kong and China slipped after the PMI data broke. Hardly a vote of confidence from investors. So, is China's slowdown just a temporary dip caused by trade skirmishes and the summer slump? Or does it point to deeper structural problems in the way the economy is built? Is throwing money at consumers, like with childcare subsidies, enough to spark the next engine of growth? Or is a more radical rethinking needed? Does anyone still believe that price wars among manufacturers can be a pathway to long-term competitiveness? Chime in. Do you agree that China needs to overhaul its growth model? Or do you see the current weakness as just a rough patch? Are the new childcare subsidies a sign of progress, or just window dressing? The comment section is wide open for debate, and this is one issue where nobody seems to agree on what comes next.